All right, let's jump right into this explainer. Today, we're putting on our sell-side equity analyst hats. If you really want to figure out what a company is truly worth, you have to dig into the actual financial statements. So we are opening up Stride's Q3 2026 10Q filing. We're going to explicitly extract their core operational segments, map out their cash flow statements, and analyze their legal disclosures to calculate a rigorous, document-backed intrinsic value. To build a proper discounted cash flow model, we have a strict sequence to follow. We'll kick off with a product and operational deep dive, then assess material risks and lawsuits, calculate unlevered free cash flow, estimate our cost of capital, and finally, bring it all together for our DCF and intrinsic value. Okay, part one, product and operational deep dive, the business reality. We absolutely must ground our financial assumptions in exactly what Stride sells and how they make their money. Looking straight at the business description in their latest filings, Stride basically operates virtual academies. They've built these long-term partnerships with public school districts all across the U.S., using a blended learning model that mixes digital curriculum with live teaching. But to truly gauge their momentum, we've got to look under the hood at their specific operational segments. Now, they do offer adult learning, which, by the way, is currently pivoting to a B2B model, and they're rolling out some new K-12 tutoring services. But honestly, their revenue is overwhelmingly driven by two main engines, K-12 general education and career learning, which specifically targets middle and high school students with vocational and workforce readiness programs. And just look at this Q3 2026 data. It's literally a tale of two entirely different businesses. Career learning is absolutely exploding. Revenues grew nearly 16% year over year to $259.5 million, completely fueled by an 11.6% surge in enrollments. But general education, that actually shrank. Revenue decreased by 3.6% to $357.5 million, directly tied to a 5% drop in student enrollments. This brilliantly illustrates our core operational thesis for the DCF model. Career learning, that is the engine, driven by massive secular market demand for alternative vocational schooling. General education, on the other hand, is the wobble, suffering from high attrition rates and really tough state funding comparisons. So Stride's entire terminal growth relies heavily on scaling that engine to offset the wobble. Moving to part two, material risks and lawsuits, the catalyst. Because before we project a single dollar of future revenue, we have to impartially factor in a severe headwind detailed in the legal disclosures. Stride is currently facing a class action securities fraud lawsuit. Investors are alleging some pretty massive discrepancies between what management promised publicly and the actual boots-on-the-ground operational reality. Now, as analysts, we aren't here to take sides, but we absolutely must price the potential fallout into our risk models. Let's look at how this built up chronologically, because a huge gap opened up over just a few months. In early 2025, management was out there claiming the macro environment was, quote, as strong as ever. But fast forward to October, and the tune changed completely. They suddenly disclosed poor customer experiences, higher withdrawal rates, and a totally unexpected loss of up to 15,000 enrollments. And when the company finally revealed that massive enrollment shortfall to the public, well, the market reaction was violent. The stock plummeted by $83.48 in a single day, a 54% drop. Boom. That right there is the exact catalyst for this current class action. The legal complaint alleges some incredibly severe operational failures. The plaintiffs claim Stride essentially inflated their numbers by retaining what they call ghost students, kids kept on the books who weren't really there. They also allege the company cut costs by overloading teachers way past statutory limits. Whether that's proven true in court or not, it fundamentally alters our risk assumptions. It signals operational instability, which means we must use a higher discount rate in our valuation model. All right, part three, unlevered free cash flow, the bridge. This is where the rubber meets the road, taking those operational realities and translating them into tangible free cash flow. We source our inputs straight from the Q3 unaudited, condensed, consolidated statements of cash flows. We start at the top line with a net income of $256.8 million. But as we all know, net income isn't cash in the bank. To bridge this, we add back non-cash charges, like $92.7 million in depreciation and amortization. Then, we have to subtract a massive $305.9 million drag from accounts receivable. And finally, back out $37.4 million in capitalized software development costs. The formula to bridge this is really straightforward. Operating cash flow minus strict CapEx. So, subtracting property equipment and that heavily capitalized software from their operating cash leaves us with a 9-month unlevered free cash flow proxy of exactly $60.7 million. That is the actual cash generated by the business. Part 4, Estimating Cost of Capital, the WACC. To figure out what those projected cash flows are actually worth today, we have to calculate Stride's cost of capital. Think of WACC, the weighted average cost of capital, as the absolute baseline hurdle rate. Stride has to clear this percentage just to create economic value. If their return on invested capital doesn't beat their WACC, they're actively destroying value, no matter how fast revenues are growing. If we pull up the balance sheet for March 2026, we can see exactly how they finance things. Stride's capital structure sits at $1.64 billion in total stockholders' equity and $417.5 million in long-term debt. So that gives us a mix of roughly 80% equity to 20% debt, which dictates how we weight the costs in our equation. Now, you won't find exact betas or risk-free rates conveniently stamped inside a 10-Q filing, so a proper analyst has to explicitly declare sensible external defaults to calculate the cost of equity via CAPM. We're using a 4.5% risk-free rate based on standard 10-year treasuries. We're assigning a beta of 1.1 to match the EdTech peer average, and we're applying a standard 5.5% equity risk premium. Which brings us to Part 5, DCF and Intrinsic Value, the verdict. This is where we assemble all these pieces, the operational trends, the cash flow bridge, the discount rate, into our final model. We step through the valuation by forecasting out 5 years. Management recently narrowed their fiscal year 2026 revenue guidance to somewhere between $2.49 and $2.52 billion. So we project our cash flows off that base, driven mostly by that career learning engine. For the terminal value, we apply a 2.5% growth rate, basically mimicking long-term GDP. And finally, we discount every projected dollar back to today using our WAC. So based on all these rigorous fundamentals, crunching the data, and heavily discounting for that legal risk, our baseline DCF model yields an estimated intrinsic value of roughly $85.50 per share. That's what the pure math says the core operations are worth. But here's the thing. The math just gives us a number. Investing requires context. You have to ask yourself, at $85.50, does this valuation offer a wide enough margin of safety against catastrophic ghost student allegations and shrinking core enrollments? The fundamentals are strong, but the qualitative risks hanging over the stock are massive. And resolving that tension is exactly what you have to do before allocating a single dollar.